Welcome to the CLS Monthly Market Review. I'm Rusty Vandeman, Chief Investment Officer at Orion, and with me this month is Case Eichenberger, Senior Client Portfolio Manager at CLS Investments.
Hey, Rusty. How are you?
Welcome, Case, and welcome back. You've been gone forever.
Yeah,
You're on the road.
We've been traveling a lot, talking to, hundreds upon hundreds of financial advisors out there for really the end of year focus and kind of getting geared up for 2020. So
Awesome.
It's been a great trip on the road.
Well, I want to talk a little bit about that, but first of all, let's talk about market performance. How was November and how's the year looking so far?
This is the monthly review, right?
It is.
So global stocks were up about 2.5% to 3% for November, so a very good November. Really all major asset classes participated, but you did see emerging markets about flat, and then treasury yields rose a little bit. So you saw bonds flat to negative a little bit. Some other asset classes that are interest rate sensitive, like real estate and utilities, were negative as well. But overall, stocks provided a boost in November.
And how, for the year though, it's a great year, right?
Yeah, you've talked about it a lot. It's going to be maybe one of the best years on record, at least here in the US, which is, I think we're up about 27% or so.
Yep.
So if you kind of just look back at 2018, rough year, 2017, great year, 2019, great year. There's no pattern here, of course, but regardless, It's been a phenomenal year.
I do think that December should be a good month. It usually is. Not every year, like last year is a good example, but usually it's good. I think there's 3 different commentaries CLS has written recently talking about either the last 20 years, 50 years, or 70 years, different writers on each of them. But in each case, of course, December is typically one of the strongest months, usually positive. If we do get a really good December, as I've written, we could have not only the best year in 20 years, but we could have the best year for the U.S. stock market since the 1950s.
That would be amazing.
That's going to be a great headline.
That would be great, right?
Yeah,
Coming
absolutely.
into 2020, for sure.
All right, so let's get back to some of the stuff. You've been on the road a lot. What are some of the common questions you're getting when you talk to advisors these days?
Well, I think kind of what you just mentioned, with the great year we've had here in 2019, investors' appetite for risk, I still see a lot of people, one, being a little bit bearish. Also, they're happy they're getting their returns. Some are more bullish, right? They want to really extrapolate the returns they've gotten this year into next year and keep taking more risks. So you get a balance of both, of course, with everybody I talk to on the road.
Right.
But I guess that comes down to, kind of the questions is, how do we properly score risk, and what should I be looking at for benchmarks? So those are some of the questions, and I know you hit on some of those.
Well, that is a great question. Well, one quick comment is, when it comes to risk, when an individual investor comes into a financial advisor, 2/3 of the time they find out their asset allocation could be improved upon.
Yeah.
They're either not taking enough risk or they're taking too much risk.
Right.
I don't write about that in the weekly 3, but what I do write about is exactly what the question you had, and that is regarding risk scoring and how important it is. And a lot of risk scores, if they have problems, there's a tendency, there's 3 different reasons why.
Okay.
Now, you're right about that. And so the first thing is that the risk scores need to really match with client expectations. So a great example is, let's say you're an investor and you have a risk tolerance of 100. That means you're completely comfortable with market risk. You're very knowledgeable about it. You have a long-term horizon. Then your portfolio should have 100% market risk.
Sure.
Basically. A lot of risk scores don't match up that way, surprisingly.
Yeah, I've seen some of those. They're maybe a little bit tailed to the skew to the lower limit.
Well, the second problem is dealing with benchmarks. A lot of times the risk scores have an inappropriate benchmark sort of behind it. You really need to make sure it matches up. One solution to that is targeting a risk level as opposed to an asset allocation. That way you can look at a lot of different strategies with common risk characteristics.
Right.
And that way you kind of get a better risk score out of it. The third thing, which is really important, is a lot of risk scores get stale. Somebody might be using a risk score that's old and things change. A great example to that, which I think surprises many investors, is this year, when you look at U.S. stocks versus non-U.S. stocks. Non-U.S. stocks are traditionally more volatile, but this year they're less volatile. And quite frankly, investment portfolios should reflect that change in risk.
That was amazing when you put those stats on the page, which I really think readers are going to find interesting, right? Over the last 1 year, international stocks are like a 76 risk score, right? 76%. Where U.S. stocks are more than 100. And a lot of that had to do with, I think, the fourth quarter of last year where international stocks did better. So that was interesting.
Those numbers really surprised even me.
Yeah.
We knew it, but when you really see that, it really shake out.
Yep.
And again, portfolio should reflect that.
Yeah, absolutely. So I think kind of going on with themes of from the road, we talk a lot at CLS about global investing, and even a lot of other predominant asset management firms talk about it as well. But always the question is, what's the right mix? Is it 10% international of my U.S. equity or my equity portion, is it 10%? Is it 20? Is it 50? What is our thoughts on that? What is your thoughts on that?
Well, I mean, I do love this question. I think we both do.
It's a good thought exercise.
Well, first of all, I mean, you think about the short term, what we would call maybe a tactical assessment. And in terms of expected risk and expected returns, I mean, investors should have more international right now. I mean, we just talked about the risk. I mean, the risk characteristics of international are a lot lower than they have been.
Yeah.
So if you're managing a portfolio in terms of its risk characteristics, you probably want more international. More importantly, international securities, because they have lower valuations, are priced for higher returns in U.S. markets. So from a short-term perspective, you should have more international. Now, thinking longer term and strategically, again, what is sort of frame of references that investors should have? And there were three of them that I wrote about.
Yeah.
First of all, the SEC, the Security Exchange Commission, suggests that if you're going to call yourself a global investor here in the U.S., you need to have at least 40% international. So that's the first one. If you look at the All-Country World Index, the stock market index for the entire world, right now it's about 45% international. I mean, my rough rule of thumb's always been 50-50, but U.S. has done better.
Yeah.
Third, there are various studies that show kind of the sweet spot for risk reduction in a global portfolio, and then that number is between 40 and 50%.
Right.
So you add it all up, at 40% plus seems to be a pretty good number.
Yep.
The average investor in the U.S., however, is closer to 25% international right now.
And I almost thought that was high. Because you kind of just, the people you talk to on the road, but
it does. And I thought I agreed with that too, but it's true.
There's still room to add. And sometimes the question I get is, well, I have, U.S. large cap multinationals that gain a lot of revenue from overseas. I don't really need any overseas exposure, which obviously we would take the other side with to try to educate and talk about, well, one thing, you want some currency exposure, right? Currencies are a great diversifier themselves.
Yep.
And most multinationals hedge their currency exposure. So
first of all, that argument about percentage of revenues is very rational.
Right.
It makes a lot of sense, but that isn't just how the market behaves.
It
just isn't, right?
Exactly. So I guess, and then on to the third section was active management, passive management. We use a lot of ETFs, and ETFs I think are over 4 trillion worldwide. A lot of people are going into passive market cap type investments. Is there room for active management in this mix going forward?
Well, we have our biases because we do think that to manage a portfolio, you do need to make active decisions.
Right.
And when we say active, that means you're different than the benchmark. And you just don't buy the benchmark. You do need to look at fundamentals. You need to look at valuations. Active management hasn't been really rewarded in recent years, of course. You've been in an extended bull market. U.S. large cap stocks have done really, really well. But I think that active management's time is due to shine for a variety of reasons. Well, first of all, you're kind of seeing it already. Value is, at least in the U.S., is starting to turn around, and you're starting to see active managers do better as a result of that. Basically, if active management is doing better, that means business models matter.
Sure.
That investors are now looking at not just market exposure, but they're looking at business models, which you would think makes sense in the first place. And I think you can kind of see that, and I have some of those stats regarding it. Also, when it comes to passive, a lot of it has been led really by 6 companies in the U.S.
Yeah.
And
that I can guess them.
Yeah.
Right?
You want to guess them right now?
Facebook, Amazon, Netflix, Apple, Google, or Alphabet.
Yeah.
Did I miss one?
Microsoft.
Microsoft. That's
the
right.
Fan Mag.
Fan Mag.
That was a good job. You did it fast too. I do it backwards. No, I'm just kidding. Well, a couple of different stats about the Fan Mag, which I thought were pretty cool, is first of all, if you just total the market capitalization of those 6 and acted as if that was a country itself.
Just those 6, yeah.
Just those 6. The only 2 countries that have larger stock market indices are the United States and Japan.
That's amazing.
That's bigger than any stock market in Europe.
Jeez. Yeah.
Apple is larger than the entire energy sector right now in terms of market cap.
Gosh.
Apple and Microsoft are larger than all 2,000 small cap companies. Those are all great companies, but are they worth that much?
Yep.
And so, and quite frankly, most active managers, well, at least those with the value orientation, tend to be underweight those names.
Sure. Yeah, absolutely.
And so, anyway, I had a lot of little nuggets in there. So
definitely, yeah. Anyway. I mean, take a read, right? Because the active management, I think, is still an important talking point. And just your last section, talking about factors, getting more towards those small caps and mid caps and value, which have been out of favor recently. But when they are in favor, active management does better.
Absolutely. Again, so something that we've talked about a lot, is the difference between value and growth stocks, the difference between small versus large versus international versus domestic. All of these are in, it's been multiple decades we've seen these sort of relative valuation differences. So when these all turn around, which it looks like some of them are,
starting to,
then active management should do well.
Definitely.
Oh, great. Well, welcome back, Case.
Yeah, thank you.
All right. And thank you for your time and trust in CLS Investments, and we'll see you next month.